Credit and Collections Lending Technology think tank. My name is Colin White, and I'm from Credit Connect Media. Wanted to welcome you all to this latest session in our series. And before I start, I just want to really thank our sponsors of today's events and sessions. So that's LexisNexis Risk Solutions and Acquired for supporting and helping make this event possible. As we're all fully aware, the cost of living continues to impact lending and credit, with interest rates and consumer duty, amongst other factors, impacting lending and credit decisioning. At today's events, we'll be looking at those kind of subjects through our two sessions. So I just want to quickly share with you the plan for today's event. For those of you who obviously tuned in now, we're going to cover credit risk and the cost of living challenge. We'll have a slight break at 10:30. And then at 10:45, we will have our next session on open banking and lending technology. So if you haven't already registered for that session and you want to see that one, then obviously register through the link which is on our screen in front of you. And on that note, I just want to talk you through really quickly how you can interact at today's event, because there's lots of ways you can do that. There's the social tag. We've got hashtag hashtag LensTech, and on that you will be able to obviously share your thoughts on social media through X or Twitter, and then LinkedIn. Then in the left-hand side there, you've got the information on today's event, which you can obviously see. You've got a little person indicator, so on there it's got information on all of our speakers, so have a click on that and find out their background. You've got a folder where you can find information and links on today's sponsor and also Credit Connect, and find out more information about our upcoming events as well. But the important part on here is the speech bubble. We'd really encourage you to get involved and ask questions via that. They'll be typed in, you won't be shown on screen, so don't be afraid to ask them, and we can put them to the panel. On that note, if we don't cover anything today in terms of your question, then we can obviously give you a response via our event review, which will be published next Thursday on the Credit Connect website, where we'll have a review of that. That will also include our survey. So today there'll be a couple of surveys that pop up across the screen. We won't really review those results because we usually don't have enough time, but what we will do is cover them in the event review. So again, please get involved with that. It'd be great to see your feedback on that, and get your responses on there as well. So yeah, this session is going to be talking about risk solutions, and in this session we've got a variation of speakers, really good speakers here. So, but tying it all together is our event chair for the day, Chris Warburton from our strategy. Chris is going to introduce that, and of course we'd like to thank our sponsor of this session, LexisNexis Risk Solution, for their support on it. So without further ado, I'll hand over to Chris, and he can introduce our speakers, and we can get the conversation going. So Chris, thanks for your help.
Thanks very much, Colin. Morning, everyone. So this first session, we're going to talk a little bit about credit risk and the cost of living challenge. I think we've got a very interesting, morning with a couple of interesting topics. But this one here, particularly, we're going to talk a little about, how it's really dominated the headlines the last few days, the last few years, both in the UK but also internationally. And so this session here, specifically on cost of living, we're going to talk a bit about what impact that's had on credit risk, what impact that's had on the lending market, and what does that mean in terms of like lending volumes that have happened now. We've been in this for a few years now. Is it having an impact? Is it not having an impact? How is it having an impact? And what's the sort of like technology and changes to risk appetite that we've had to really make in terms of our lending processes? And I suppose just looking forward, I think it feels like the economic outlook is probably mixed at best. So questions really I've got really around things like, well, what does the future look like? Do we need to make more of a change in mindset going forward? Really to sort of think about lending and managing profitability, especially when we've got higher interest rates as an example and a less stable economy. What does that do to the lending process, and how can we get around that with things like data, etc.? And what are the areas to look at in terms of like finding extra growth or finding resilience within our portfolios as well. So this session here should be an interesting session. It's going to be a bit of an update in terms of what's happening economically, what's happening with credit risk, for really from the panel. And as Colin said, we got a great panel with us. We got George Bronze, who's the head of unsecured credit risk from Virgin Money. We got Eleanor Demuth, director of risk from Curve. We got Chanuka Perera, who's head of UK credit risk from Zilch. And we've got Neil Allen, who's the head of strategy from LexisNexis, who are in risk solutions, and they look at a lot of data solutions as well. So to everyone, thank you very much for joining and welcome. And I suppose to kick off the discussion, what I thought the first question was just like, what has been the impact with the current economic environment, really on things like lending and lending volumes? I mean, Eleanor, I think maybe I'll just start with yourself and just find out. I mean, what have you been seeing over the last sort of 2-3 years, and particularly over the last year?
Well, I think there's several observable trends, but I don't want to steal anyone else's thunder. I think for us, being a relatively new product, maybe our population is skewed anyway, but what I'm seeing is that people are borrowing less for desirable luxuries and more for things that could be considered expected expenses. People are needing to spread that load. And that may be partly because of the gig economy as well. It's not necessarily wholly because of the cost of living crisis, but the reaction to that cost of living crisis of maybe having two jobs, one of which sustains your main income. There's a lot more volatility in the data and volatility in people's lives. And I think that's leading to a caution as well in terms of credit. It's not just that the people that were buying attractive luxury things aren't buying them. It's that they're more aware of the potential for shock in their financial lives and therefore are more cautious of taking credit.
Yeah, so it's like a change.
A big round effect, but I'm sure other people will talk about that.
Yeah, so it's like a change in what people are borrowing for to a certain extent. I mean, George, what you guys kind of seeing?
I think that's entirely true. So certainly in the secured space, I think that trend that Eleanor refers to is really true, right? You've got more of the needs to moves than wants to moves. And I guess as people adapt from sort of 15 years of lower rate environments into higher rate environments, I think there is that degree of consumer caution. I think in the unsecured space, it's an interesting one because I think that as lenders react to COVID and then cost of living challenges and being able to manage portfolio performance within risk appetite, it actually leaves the real challenge around who's the market still serving. So I think that's one of the worries that we think about quite regularly internally is about, we need to manage our own credit risk and being able to understand that and ensure that our portfolio is resilient through, as you say, Chris, the kind of lumpy economic forward look. But I guess it's what that impact is on consumers and how we as a credit market can continue to serve all the different segments in the market that exist. And I think there's becoming a greater divide between those haves and have-nots. And I think, you look at inflation still remaining sticky, but wage inflation still being high. And that's kind of having disproportionate impacts on different segments of the consumer market. So it's one we're really alive to. And clearly, from a credit risk perspective, our first principle and duty is to manage the portfolio, but that can't be at the expense of not serving the wider consumer market.
Interesting point there around cost of living, and we think of cost of living as almost like it's the title, right? So, and it being one thing, but actually it impacts. There's lots of different types of cost of living impacts, haven't there? That we've had energy price increases, we've had inflationary increases, we've had interest rate increases, and they all affect slightly different segments of people in slightly different ways. In terms of that must flow through to things like lending decisions, I suppose. I mean, Neil, I don't know if you in some of your data you'd had any kind of insights into that, because it doesn't feel like it's one size fits all. It's actually much more nuanced and complex than that, I'd imagine.
Yeah. So, I mean, quoting stats is always dangerous, isn't it? But we tend to use sort of Oxford Economics for our sort of forecasts around demand for consumer credit. And I think their latest stats suggest that we're looking at something like a 2.3% increase this year, which is up slightly from when we looked at the same thing last year, which I guess is a positive sign. But what we would suggest is that's probably evolving us out of cost of living into something that's more like stagnant living standards for most of the population, which obviously doesn't sound too good, but perhaps is better than it was, say, 6 months ago. The issue with that is there are proportions of the population, and I think George touched upon it with the haves and the have-nots, that are disproportionately affected by the credit situation and a downturn in the credit situation. So we looked at our short-term lending data that we have in our business last year, and we could see a significant spike in customers that were essentially taking out those types of loans for everyday essential purchases, which is not something that we'd seen historically from that data set. I think the picture is very similar in BNPL as well, in terms of how that's being used in more recent times. So clearly there is a shift in regards to how people are using credit. Some people are using it in the same ways that they perhaps would have done in the past for bigger ticket purchases, but others are most certainly using it for what we would consider to be everyday type items. So yeah, we've seen some quite big trends.
And I think that's even true for like more traditional means of credit. If I think about like the prime credit card space, which really for a lot of consumers historically was about lending cheaply, being able to kind of spread the cost really effectively. But we've seen those similar trends where the kind of proportion of essential spend that's being used on a really traditional kind of means of credit is kind of shifting because of that change in behavior and change in need. And I guess it's how we as a market continue to serve all of those consumers in that market with the right product at the right time.
Yeah. I mean, Chanuka, what was your perspective? Obviously, at Zilch, you've got BNPL exposure as well as lending exposure. I mean, what's been your kind of perspective in terms of that change of need, or how people are kind of using that?
Yeah, so we're definitely seeing a lot of consumer sentiment getting away from being able to essentially their daily budget is becoming more stressed. That's the main thing that we're seeing, where we use open banking data to try and to see the insights of consumers' day-to-day spend, and then how much is being used more on credit and versus just on their like debit card spend. That doesn't mean that these consumers are bad consumers. These consumers know their budget. They're very strict on their budget. They know how much they can afford and how much they're spending. So we're not seeing that there's more delinquency in like a broad sense, but we are seeing consumers that are more stressed. And one bad hit, so say, for example, a major life event such as a boiler breaking could be a make or break for some of these consumers. And that's when the lending space really needs to step up and step in to help these consumers as well. And like I said, these aren't bad consumers. They know how much to budget. They know what their commitments are. As Eleanor said, they are concerned about what the implications of credit would be. So they are cautious as well, but they're not bad consumers.
And what you said, Neil, around sort of stagnant living standards, I think was quite interesting in terms of so it's not like our living standards are deteriorating, but they've sort of do you think they've kind of leveled off now? So what we're seeing now is consumers might be stressed, but it is the outlook that it's not necessarily going to get worse. So we're going to see this level of stress going forward rather than that sort of like the tide rising even further. I mean, what do you think the view is?
Yeah, I think it is leveling off, for the majority of the population. I think one of the things that perhaps has gone unnoticed in the market is throughout COVID, a large proportion of the population built up quite a significant sort of savings buffer. Obviously, that sort of discretionary spend was hard to do on occasion. So they tended to put a little bit more away than perhaps they would have done, if that hadn't have happened. But the challenge with that is that buffer has now eroded away, essentially. So people are back to, what can I still afford to do versus what do I want to do as perhaps a little bit of a luxury, and perhaps being more considerate in regards to how they use credit and exactly what type of credit they use than perhaps they would have been in the past. I think for the majority of us that's probably fine for this year, but as I mentioned, there are a proportion of society that is essentially using credit just to get by.
Yeah, and I suppose sort of translating that back into for lenders. I mean, this change of environment. I mean, does that mean that you guys have had to almost like change your risk appetite in terms of like how that flows through in terms of how you're thinking about it, particularly if you're looking for areas of growth or areas of resiliency? I mean, George, you're nodding there. I don't know what you kind of think.
I think it's really tricky, right? Because certainly lenders like the one in which I work, we set risk appetite to meet our strategic objectives. It should be through the cycle. It's all about our long-term piece, but it's actually forced us to think more smartly about how we manage our credit risk within that appetite. So rather than, knee jerking to say, oh, the market's shrinking, we need to expand our risk appetite to be able to kind of continue to grow, I think it's about being smarter about the use of data, the understanding of consumer segments and circumstances, and where can we better play in those markets to maintain the kind of sustainable growth that we're looking to achieve, but also support the right types of customers with the right types of credit at the right point in time. So we've been really thinking about more innovative approaches to affordability, to how we score consumers, different tools, because I think that the reality is that the kind of approach for assessing consumers in 2024, a lot of lenders still use things that are really based on 2010 approaches, and that's not the market that we play in anymore. And I think lenders like mine are probably on the catch up with some of you guys on the panel in terms of how we think about that. That's the only real way that we can kind of support consumers in a very, very difficult set of economic circumstances, offering the types of product that we know is right for them without necessarily with a big expansion or loosening of risk appetite. Because I don't necessarily think that that's good for the market for all lenders to do that, but it's about playing in your own spaces more effectively.
So it's around finding the goal that's sort of like within your existing sort of, processes would be to sort of find a nuance to find extra opportunity.
It's small things like, is it appropriate to have one affordability assessment for a segment of the market that's now this wide? Is it appropriate to use a model that was based on like a particular segment for scoring when that's really shifted and consumers have changed? Is it appropriate to still ask the same questions that you would have asked someone in 2005 about what their needs for credit are? I think the answer is no. I think we all know that. But it's about doing that in the way that enables you to manage that credit risk within your appetite as opposed to a blanket loosening.
Yeah. Eleanor, you're going to jump in. So.
Yeah, I mean, we've not shifted our risk appetite. It's exactly the same as it was, but how we achieve that is different. I was recently looking at a retro to establish volatility within affordability, as you do. And of course, if I go back 3-4 years, what do I see? Peak COVID. I can't extrapolate from COVID data to say, that's how to look in the future. There's no way that would be sensible. So, we're having to use some more sophisticated segmentation, some more interesting stressing of the portfolios. And actually, it's a nice challenge for me. I love that kind of thing. But if you look at it in terms of the human impact, we do have a different, perhaps not even a different population, but a different situational group of people who are even wanting credit. I've heard anecdotally that I think something like 29% of the under 30s are cautious of credit cards, for example. There's a real almost an awareness of risk, although it's folk risk as opposed to mathematically challenged stuff. But there's a risk awareness in consumers now that I think we have to also nurture. I mean, that's a good thing in a way, but we have to make sure that it's not preventing the people that actually need credit, can use it, and can actually help sustain the economy as well, from sort of absenting themselves from the credit market.
Yeah. So
that's exactly right, Eleanor. So it goes both ways, right? Either expansion of risk appetite, a contraction of risk appetite. It doesn't always feel like it's probably historically how lenders have reacted to uncertain circumstances.
It's now, exactly.
But it's not really appropriate because it actually excludes certain segments from the market in a way that I don't think anyone wants to do that.
Yeah, but it sounds like there's also been like fundamental behavioural change, be it the pandemic that's happened, that you see in the data. But it also sounds like there's behavioural change, almost like generational, that's kind of happening, is what you're kind of saying, Eleanor. It's like, I mean, Chanuka, maybe what have you guys kind of seen in terms of that? I mean, did you sort of see that? I mean, it's a different kind of attitude towards borrowing to a certain extent. I suppose
it is.
That. Yeah,
it's actually really interesting because what we're seeing at the moment is while traditional lending typically is starting to exclude some of the more at-risk consumers, we're finding it at probably the most opportune time for us because we are more willing to take on these consumers. Of course, what we've had to do is strengthen our affordability testing. We had to strengthen our risk appetite in terms of identifying which are the best consumers. But most consumers are being rejected, well, not most, about 30% of consumers are not eligible right now for traditional lending or like your standard lending. And so they are coming to alternative providers such as ourselves. And we're finding them, to be some of our core consumers at the moment. They're probably some of our best consumers at the moment because they need the credit and they understand how credit works. Again, they are cautious. We find that our early repayment rates are around 50% at the moment. And that's because they are cautious about, they don't want long-standing credit. They've seen, generations of consumers being burned by long-term interest and stuff like that. And so they just want to make sure that they get their coverage for when they need to, and then they pay back when they have the money in hand.
I mean, how do we best stay ahead of or abreast of some of the changes that are happening, particularly within the portfolios? I mean, what's the best kind of way to look at it in terms of updating your models or updating the approaches? I mean, Neil, I don't know if you have perspective on that, or maybe George or Eleanor as well.
Yeah, no, absolutely, and I think what Chanuka was saying resonates with me. I think when we think about sort of financial inclusion, for example, it's probably fair to say that many of those that sort of sit within that population are perhaps judged as if they were bad credit without even being assessed appropriately in the first instance to see if they actually are that. And that's something that, as an industry that, we're seeking to tackle. I think data-wise, obviously I'm a little bit biased, but my view is that a new data source or a data source used in perhaps a different way can move the needle more than anything else, any other tool that's available to a lender or creditor, if it's used in the right way. So I'm obviously an advocate of deploying alternative data. And when I say alternative data, I'm not just talking about open banking, the transactional view. I'm talking about other, third-party type data sources that could be introduced into existing credit risk models, for example. So, we have, as a business, we have, over 70 different data sets that we use to derive our sort of scoring model. Many of those are what would be typically described as alternative data that don't typically feature on a traditional credit report, for example. So it's that type of approach that we're looking to introduce into the market more, that will hopefully allow lenders to not only assess more people in the first instance, but also perhaps be able to offer them better rates as well as a result of that different lens that it can offer.
Yeah. So I mean, so George, I was going to ask, I'm going to come to you next, just in terms of like that you talked a bit about change, I suppose. I mean, Neil's just talked a bit about using data to look at that. I mean, and you talked about the difference between different lenders in terms of like what kind of models are being used. I mean, how do you think about sort of like, because it's not about looking back in terms of what happened, it's also around how do you anticipate what's going to happen in the future. So if there are generational changes, how do you put those into your lending models? How do you start thinking about that? How do you identify what some of those trends are? Because the last 5 years, it feels like what we thought would happen is not necessarily what did happen, and when you actually look at the data, something very different that kind of happened. And so how should we best think about sort of staying ahead of those and then sort of building those into our process, rather than sort of getting caught back into this like 30, 40, 50 years worth of stability that we seem to have had?
It's really tricky, but I have the silver bullet of answers. It's having a really strong credit function, and that credit function being part of the overall organization's approach, because credit people understand people more than anything else. So couldn't agree more with Neil's view about using alternative data sources, using new things to be able to think about the future. But what really exceptional credit functions do, in my experience, is then put a person at the heart of how that all works and think about how their life's going to change and how you're going to manage their ability to access credit to do the things that they want to do. People get into this game broadly because the maths is interesting, or the data is exciting, or they enjoy the kind of thrill of making decisions that can impact customers' lives. But you put all of that together and you think about how you're going to manage that really changing set of circumstances for the consumer credit market. And the answer is to make sure that credit people are really involved in the strategic planning process of any lender's future, because they understand people. And all these tools that we talk about about and using them. We've got great people that can understand how better to squeeze more out of the lemon, turn the dial a little bit more. But ultimately, it's about people understanding people. And I think that's what good credit functions can add.
And just before Eleanor jumps in, because I can see you smiling.
I hope
We had a
Eleanor's
really
nodding
we had a
away.
really great conversation about around maths the other day. But I mean, one of the things you also said in the prep for this was around credit risk appetite was more than just around the financial or the maths around it. It's also around the emotional piece or the conduct elements as well. I mean, that I thought that was kind of interesting, which is not just about profitability, it's also about these other elements now. I mean, before you jump back, I mean, Eleanor, what do you kind of think of that?
I'm, of course, absolutely with George on this, but I think one of the things I see too often is people referring to, well, what is the customer? Who is the customer? And I'm always saying to my credit teams, even though the maths is worse, or not necessarily worse, but more exciting, you gotta think about the group of people. It's not a customer. It's not Mr. Typical Customer or Mrs. Typical Customer. It's customer A, Y, Z. You know, and they're all different, and they all have a part to play. You know, to say, oh, we've got a portfolio and it looks like this in terms of the customer, it's just rubbish. It's not like that anymore. Perhaps it was historically. Perhaps it was, you know, Mrs. 2.4 children or whatever. But now, you've got to account for, you know, Generation X, generation retirees who are on interest-only mortgages. There's a whole mix of people for whom you have to get into the personhood. And, you guys know I'm a psychologist, so that is totally my bag. I love it. And it is about how they think about credit. It's not just about how they use it. And I was interested in what Chanuka was saying about people repaying early. I think that's an enormous indicator of attitude to credit. You know, it's anyone that repays early and doesn't immediately take out a loan for a lesser rate. Let's be careful there. It's an indication of a mindset.
Do you think we talk about the people aspects of it enough on these kind of calls? I mean, so I love the maths and I love the data as well. I have to say as well. But do we talk about the people aspects and even the data side around the people aspects of it in terms of what that kind of means? I mean, Chanuka, what you kind of think of the discussion and what's being said?
I mean, I agree that we talk about the maths is probably the most forefront thing that we talk about. At the end of the day, unfortunately, we are working for a business, so like the numbers and the profitability and all of that has to be the end goal. But the customer is the forefront, right? We have to be thinking about the customer each time. I mean, even just every decision that we make has to be, why does the customer need it? What are they using it for? Like, we want to be cautious as well. We don't want to be giving money to someone that would just take it away gambling or something. Not that we would, but we have to always be the customer's intention has to be at the forefront of what they're doing.
But
I think about my sort of evolution in terms of what I've seen in my career today, and risk appetite statements evolving quite significantly. And we don't just think about measuring the performance of our portfolio with a marginal bad rate at 12 months anymore, and just that entirely be driven by a profitability decision, because it can't be. It's got to be more than that, and consumer duties really forced us to think about that. But we were already on that journey to thinking about, exactly to Chanuka's point, is the product designed for the right customer? Is that customer taking a product that meets their needs? Do we make the relevant profitability for us as an organization to be able to be sustainable as a business? But are we supporting customers with the right type of lending at the right time of their lives? And I think that risk appetite statements have really evolved to think much more about just being beyond profitability and ROE, but actually from a conduct perspective and the customers that you're assuming, you can't just think about bads and goods anymore. You've got to think about the person at the end of that decision.
Yeah.
And it's very difficult to deal with that in terms of treating customers fairly, because are you treating one customer differently from another? And if you are, is that appropriate? If maybe you can justify it, great. But in terms of the customer themselves, do they feel that they're being treated the same as everyone else? It's a really hairy problem, and I'm loving it. But that's just me.
How much do you think technology has been an enabler for this? So if we go back even like 20, 30 years ago, I mean, we used to be having almost like broad brush portfolio type decisions that were being made, a very sort of much more sort of like generic kind of scorecards that were out there. And it was very sort of, it was stable, but also we didn't have the technology to be able to look at the nuance around whether this person who might have been declined now has these other characteristics using extra data that they can now be approved. I mean, how much do you think technology's actually an enabler for this in terms of like moving us forward? I don't know if anyone wants to take that. I mean, Chanuka, maybe comment on that, because I know you guys have
Yeah,
invested a lot in it.
I think it's very interesting when you say from 30 years ago to now. I think the fact that we can make a decision within 30 seconds, pulling data from across the country, finding every like aspect of the customer's financial position at the moment, and being able to make a decision almost immediately is incredible. What is and the thing is, it continues to evolve. I have conversations on a weekly basis on people with new alternative data, with new different aspects that we haven't seen before. It's absolutely mind-boggling just how integrated everyone is. Everything is connected right now. It's incredible, honestly. This industry is probably like one of those industries that continues to evolve. There's probably no stopping. There's no like end solution, because there's more and more that we can find every day.
I mean, yeah, I mean, and the technology allows us to do the processing. I mean, going back to the data, I mean, what kind of extra data is out there? I mean, Neil, I know you're going to comment a little bit about open banking data, but also alternative data there. I mean, what sort of new kind of feeds are people sort of like looking at?
Yeah, I mean, so just before I get into that, Chris, I think from the supplier side, technology is making a huge difference. I think obviously machine learning capabilities, and I know the panel next are going to talk more about AI and things like that. But the ability to sort of crunch vast amounts of data is something that shouldn't be underestimated in regards to us being able to potentially use other new types of data and mobilize that very, very quickly, and obviously get that out to customers to potentially benefit from. In terms of new data types, obviously BNPL is one that everybody is looking at. I think many organisations are perhaps waiting to see what happens in regards to regulation that we all expect to happen. But if it does get regulated alongside sort of unsecured consumer credit products, I can see that data being particularly valuable, not just for providers like Chanuka, but also lenders that want to understand their risk exposure from that channel, if you like. The other thing that we look at a lot at LexisNexis is digital signals. So these are already used a lot, device-based signals, email risk, insights, all of that sort of stuff is already commonplace in fraud assessment. I can certainly see some of that sort of bleeding over into sort of credit risk and potentially affordability assessment as well in the future. Of course, the challenge with any new data sources is it permissible, for the purpose, particularly with the UK regulated environment. We have to be very careful about, how we sort of introduce those new sources. And another set of data that I think is potentially underutilized in the UK is what we would perhaps describe as asset-based attributes. So obviously property, vehicle insight, vehicle ownership, property ownership, all that type of data. There's vast amounts of information already used in other sectors like insurance around that to make decisions about what type of insurance an individual is suitable for. It would suggest to me that there will be some benefits from a credit risk use case perspective as well from that. But really, with the amount of data that's being created on a daily basis, I think it's inevitable that there are going to be different things used in 12 months' time than perhaps what we're utilising now in our sort of credit risk processes.
I mean, it kind of feels like the availability of data funnels are sort of expanding, and it's almost like accelerating, almost like exponentially to a certain extent as we get, as technology pervades more of our lives. I mean, one of the challenges with it, I suppose, is then how do you how do you filter through all that to then understand where that value actually is? I mean, Eleanor, I know as come to you just in terms of like, what's your approach around doing it? Because as Neil just said, there's some fantastic data out there, but we've got to almost like filter it down to then make it meaningful and then link it back to some of the other stuff we talked about around consumers and default rates and but all of those kind of things as well. I mean, how do we best approach it so we don't almost like get overwhelmed?
Well, I mean, I'm incredibly lucky in that we have a wealth of internal data. Curve being an over-the-top processor of all kinds of financial data. I mean, we know how many points people have got on their Boots card. Do you know what I mean? But I think more generally, I have a large concern about not only the digitally excluded, but the data excluded. I think, Curve users by their nature are digitally aware, they're savvy, they're those people. But there's an awful lot of folk out there who, are only just getting to grips with a smartphone, or who maybe don't want to engage in the ways that we're telling them to engage in order to obtain credit. So I think there's a problem there. And I think in terms of not getting swamped with the data, the important thing there is to consider it as more than data. So, a lot of the time the temptation is to just throw a lot of muck at the wall and see what sticks, use a standard program or something to just throw it all in. But actually there's a lot of information that you should consider abstracting from that. So, I mean, the classic example, back in bad old days when I used to buy bad debt, if you put the most recent payment date into any model dealing with bad debt, it overwhelmed all others. Of course it did, because it's about whether you can contact that person, whether they're willing to pay you. But that's not a very helpful thing, because guess what? They haven't paid. So I think being able to pinpoint some data items that are so obvious that you shouldn't consider them data, but rather information in their own right is the key to not getting overwhelmed with pure data.
And also, it's the classic.
I'm maybe a bit garbled, but I hope it makes sense to you guys.
Yeah, I think it does, Alan. It's the risk of analysis paralysis, right? Is that there's so much data out there, and it's becoming more and more available that just this extra bit will give me the answer that I need to be able to make a better decision here. And whilst that might be true, and as we kind of explore these new data sources, it doesn't take away the fact that credit's still a skill, a judgment. It requires people to be able to put themselves in the consumer's shoes to be able to make the right call around. And today, particularly in unsecured and more insecure, and even businesses taking steps towards it, that's becoming more automated, and it makes it like, you do need all these data sources, but the risk of analysis paralysis in our industry is really, really high, I think, because of the nature of the types of people that are interested in it. So it's balancing that continued thing about just that extra piece is going to give me the answer. And in reality, if you can find the right call earlier with maybe a few less pieces of information, do you still help that customer in the right sets of circumstances? Really tricky balance.
Is that where the human understanding comes back? So sorry, Ellen, I was going to come back to something you said earlier around sort of like if someone's repaid earlier and they don't take out another loan. I mean that could be non-intuitive from a data point of view, but it's intuitive from a customer understanding point of view. And so is that the piece that's kind of that's why it's important in terms of like using that to then find areas to then investigate with the data. Sorry, I didn't mean to interrupt, but it was linking back to what George was saying.
No, exactly that. I mean, and back to what I was saying about splitting out the customer into not just the one customer. There's a lot of analysis here that you can do that is far more valuable than lumping it all together. So, for example, you should definitely be modeling for fraud, but you should be modeling for fraud inside your bad debt, because that's where it's going to live. If you've already identified it as fraud, then you've already done the work. So you have to chunk it off and say, okay, this is the bad debt. Where's the fraud within that? And then equally, you've got to say, okay, this is the good debt. Where's the profitability within that? There's a lot of pieces of data mangling rather than just taking all the data and throwing it at the single problem.
It feels like it's definitely becoming a more complex world. Chanuka.
It's not.
I remember like maybe 10 years ago when all the job was you take the data source and you look at the correlation between that and loss rate and you're like, job done, it's correlated, chuck it in the model. I think we're just so much more nuanced than that now. I think, as everyone just mentioned, like there's so much more, you need a much more understanding. You need to understand the biases behind that data as well. And then making sure that you're using it in the right way, which I think is something that we're all aware of, and it's something that we want to make sure that everyone else is aware that we're aware of it as well.
Yeah, and what's the approach? I mean, I got written down here financial exclusion, but you mentioned digital exclusion earlier, and I suppose data exclusion. Sorry, it was. I mean, how do we think about that, particularly within lending businesses, right? Because you might have predominantly sort of digital kind of lending businesses. That does that sort of excuse you from some of that? I mean, how do we think about sort of making sure that people aren't being excluded, or this sort of drive towards inclusion versus making sure that that's profitable? We understand. I mean, Chanuka, maybe just come back and comment on that a little bit. How do you think about that? I mean, and what kind of risk is there around, I suppose, financial exclusion and having people like being left behind?
So there's a line that we're trying to balance here, which is trying to be as inclusive as possible, but we also need to like KYC this customer. We need to know that this customer is who they are, and this is where it becomes really difficult because these customers don't have too much of a digital footprint, and at the same time, some of these customers don't even have like a photo ID. So they come to us with a birth certificate and asking if we can validate with them like that. So we do very careful hand holding of these kind of consumers because we want to make sure we're doing the right thing, that we do KYC these customers properly. But these customers literally have not much awareness of like much footprint in the industry, and it makes it really difficult. They might just have one savings account, no credit products at all. How do we know that this customer, like everything about this customer, compared to a standard customer where we know pretty much all of their consumer lending? It's really hard.
Yeah, I mean, George, what's your kind of reaction to that, or your kind of approach to that, given that you're sort of, redesigning your models to a certain extent, and probably have some of these other customers as well?
I think for a lender like mine, it's really challenging because of legacy technology, legacy estate. But we shouldn't hide behind that and just use that as our excuse to not try and do a better job of it. So I think lenders are more keen to do test and learns and understand behavioral shifts of consumers, because I think that's probably the one bit that I think that we're coming back to cost of living that we're seeing more and more, is that actually, whilst the assessment and affordability and everything that makes up a decision to lend is kind of evolving, actually the consumer behavior is evolving as well, and the implications for our credit risk is really high. So it's trying to understand all those pieces together to then, and particularly for those that aren't sort of your typical customers that we might lend to, it's really tricky for us to understand the behavioral implications of those consumers that have historically been excluded, what that might mean when we give them credit. So I don't have the answer. I wish I did, but I think it comes through being brave enough to test and learn, understanding the parameters of that, and then actually admitting when you failed in that, and then trying to improve that going forward. Continuous improvement.
Yeah. And that's sort of going back to the data piece, I suppose, to a certain extent. I mean, we're sort of trying to use this data sort of like to help us understand that, or at least illustrate some of the some of the elements. Once we've tried to understand what the consumer's kind of doing. What about challenges working with some of the new data as it kind of comes through? And we talked about volume, but also it can be in different formats. And then I was going to ask you this question because I think you definitely mentioned it in the session earlier. But Neil, I suppose in terms of like how the data is being presented to folks, I mean, is it presented in like different formats? I mean, what's like some of the complexities that even you guys see, right, in terms of like processing and then sending it out?
Yeah. Well, naturally, the more types of data you bring into an ecosystem, one like ours, for example, the LexID ecosystem that we have, you have to be able to synthesize that down and process into something that's usable, for lenders. We couldn't, for example, just ship some of our data sources directly to the lender in the formats and structures that we receive them in. And which is why, this is where we add value, throughout the credit risk journey. We model that data. We obviously test that data to prove its predictability. And then we offer clients the opportunity to test it for themselves against their own, often in-house built models that are already very, very sophisticated, in their own right. So we do a lot of work in regards to making the data more usable from the source through to the lender. Otherwise, it just wouldn't be practical. It'd be too time consuming, for our customers to even begin an assessment process for it if we didn't present it in such a way that they could essentially pick it up and use it in their models to test and learn, as George says.
Yeah.
That being said, Neil, I remember when I started my career and I did my SAS exam, and I thought I was set for life now because I know how to use SAS. I'm always going to have a job in a credit risk world. And the reality is that, the industry's moved on so much that actually it's about, I'm not sure it's about the actual technical skill set as much anymore, but about having people who are curious enough to learn and curious enough to push boundaries, so that you don't just hire your typical credit risk analyst who's got 10 years experience in SaaS and has a base exam or whatever that might look like today. But it's about having people with mindsets who are curious enough to go and explore what that looks like, and not being put off by, text files being sent to them or image files or whatever that might look like. It's the inherent nature of people that will be able to enable them to use that data.
And what was your kind of view on data and processing data? I mean, what are some of the challenges that you guys have seen?
Well, we're just going through a wonderful exercise right now of manually classifying a whole bunch of open banking data. Not because it hasn't been done before, not because it couldn't be done perhaps better by AI, but because we need to know that it can't be done better. So that's painful and manual and kind of cheesy in its own way. But as George was saying, you learn from this data. I actually am a big fan of getting mucky with it and getting into the raw data, not perhaps every day because it'll drive you crazy, but with reasonable regularity, because it's where the devil's in the detail, and it's where you learn from. I'm having an interesting time with open banking data because we are, by our nature, eating that data. We're self-consuming. So for example, because Curve is an over-the-top app, if I use my Curve card to pay for everything on my credit card, and then I get the open banking data for me, all I see is me paying my credit card. And yet I'm using open banking data to drive what we offer. So we're actually damaging our own data by our activities. It's a bit like Schrodinger's cat. As soon as you observe it, it's changed something. So yeah, I'm actually a big fan of getting into the dirty data, even though it's painful and disgusting in some ways.
And you mentioned open banking there, which is kind of an interesting topic. I mean, we've sort of seen that. I remember like 3 or 4 years ago. I mean, it was like we were very concerned around sort of adoption rates and those kind of things. But now we seem to be hearing much more about it. It feels. I mean, are you guys sort of noticing that maybe adoption rates are way higher than they used to be? I mean, is that fundamentally changed now, where we just sort of crossed that threshold and we're into sort of like it's something we're using, and now we're into the complexities around classifying? I mean, Chanuka, maybe just give us a bit of perspective on it, to like how you guys think about it.
So I remember when open banking first came out, the adoption rate was like something like less than 10%. And the 10% they gave it, I think half of them were giving fake bank accounts. And now what we're finding is about more than half of our consumers are like willing to share their open banking data, because I think consumers are more understanding that in order to get credit, which is something that's a benefit to them, they need to share more information. They want to share more information. We even have consumers asking, like, if I start spending crazily on my normal debit card, is that going to impact the open banking? Will that impact the credit that you're going to offer me? So these customers are aware of what we're using open banking for as well. I think it's become such a prevalent thing. And I think there's been so many companies that do open banking really well now that like it's like 2 clicks to like share your open banking. Like you do your authentication with your banking app on your phone, and then there you go. It's all sorted. So it's really simple. It's a more trusted system now. I think consumers, especially the more technically savvy consumers, have a really good understanding of what it is and what you're providing. They understand what kind of data is being shared back and forth. And I think the adoption rate's just been looking really good right now.
Yeah, I mean, I suppose there's a bit of a psychology element there in terms of just sort of trusting it and getting used to it. Um, I'm going to talk a bit about the future now, and what we're going to see over the next sort of like 5 years. But a couple of things there. So one was around material government intervention. So we talked about that a little bit in terms of like if you look over the last, the pandemic, etc., or even over the energy crisis, then there has been that material sort of government intervention that sort of changed people's ability to really help them to repay loans. I mean, to put it down to sort of brass tacks. I mean, because the government interventions probably helped, and it meant that what we thought was going to happen probably didn't happen in quite the same way. If we look going forward, and particularly, we can't have a crystal ball past the election, I suppose. But do you think, how do we start to think about that? So if that government intervention isn't there, what difference would that make in terms of approval rates, or what difference would that make in terms of affordability, those kind of things? I mean, how do we best think about that? Because we've almost like been reliant on it almost to a certain extent in terms of like, or consumers have been reliant on it for the last couple of years. Any kind of views or kind of perspectives on that? Who wants to go? Because we're getting into the realm of economic future.
It's challenging, I think, is my honest view, because it worries me in terms of the effects it might have on the consumer market. And I think Chanuka's articulated it really well, right? Most consumers use credit for the right reasons and understand what they're doing and want to use that responsibly. But I do worry about the effects that, pandemic, cost of living, we've had mortgage charter intervention, we've had payment holiday intervention, of what that means for what I was talking about earlier from a consumer behavioural perspective. It makes it quite difficult for lenders to understand what that consumer behaviour is. So it's not to say that it's leading to lots and lots of kind of expectations of consumers that will always exist. So I'll always have a route out, but it makes it difficult for lenders to understand what the creditworthiness is through the long term cycle. So maybe less relevant to some forms of unsecured lending. But if I think about the mortgage market, particularly, that's so tricky for first time buyers, house prices, even though they're flatlining, are still extraordinarily high. It makes it really difficult for lenders to understand that behavioral impact over a sort of 25, 35, 40-year term basis to be able to lend responsibly. So I think the positives are really clear to everybody in terms of what that's meant to enable the credit market to continue to operate in the way that it was. But I do worry that it may have just kind of prolonged some of the potential impact. It may have kind of changed some consumer behavior to an extent that we don't quite yet understand. And then it makes it really difficult for the market to kind of operate in a manner that really understands those risks and is able to operate them effectively.
It's one of those future kind of unknowns that we probably need to have on our radar screen, and there's probably a bit of a view around what might happen or what might change, I suppose, or even testing what happen if it doesn't come through. And
I refuse to accept the sort of premise that, I hear people in the industry talk about the need for a recession to be able to understand what that looks like. I think that's a really, really dangerous kind of set of language because of what the implications are for consumers. But it does mean that in this kind of world of lending where we're so heavily tied to data, and a lot of our thinking about downturn readiness is all based on 2008. So how we've kind of went through the last sort of 5 years or so, it's really tricky for lenders going forward to enable that consumer lending market to operate as effectively as we can.
I think also because of the way credit risk works, it's a very interesting industry because we only find the answers to everything maybe minimum 3 months later, more likely like a year later, after like how good that consumer is, how can we validate like whether we made the right choice for that consumer. That it takes a long time to get the long-term view on this customer. So while we have the immediate decision and we base that based on the last 5 years of history, or whatever we've seen more recently, knowing that we made the right choices takes some time, and it takes patience, and we need to be the champions of saying that we're going to do the right thing and make sure that we use that data correctly and stuff like that.
It kind of feels like one of the challenges we've currently got is almost like the cycle of that change is almost like faster than you're measuring it to a certain extent. So if you're waiting 3 months, or used to wait like 18 months for a carport, then it's like by that time it might have all changed, right? So it's more like, how do we sort of like, we're on this accelerated time frame as well. Eleanor, you're going to jump in, or Neil, I'll just ask you to maybe comment on some of those things.
Yeah. Yeah, I was just going to say that I think the less government intervention that we have is evidence that we are doing our jobs better in the market in terms of being able to adapt to, some of the macroeconomic changes that are happening that we don't have much control over. But we are still serving our customers in the right way because we're adapting to those. Without getting on my data hobby horse again, I think one of the biggest impacts the government could have in terms of intervention is potentially opening up some of the vast amounts of data that they hold on us as individuals. And then we could obviously start to leverage and utilize that for benefit, across the whole industry. I'm not going to hold my breath on that, but that's certainly one way they could help and have a significant impact.
The one question that I didn't ask, and I'll just get people's reaction to, we got the credit information market study that's coming out, which I think is really around sort of providing more information back. I mean, how do people kind of feel about that? Because it feels like the data's going. I mean, you're talking about getting data from the government, but it's also the data's going both ways. I think as a result of that. I mean, how do we think about that? I mean, what's your kind of reaction to that in terms of like where we might end up? Anyone want to comment?
I'll go on that. So this is obviously something that we're in the thick of as a challenger CRA. The credit information market study is designed to make the industry better for everybody. That includes CRAs, lenders, consumer groups, and ultimately consumers. So I'm a fan of the market study. I don't think everything has been catered for in the report that they released towards the end of last year, but as a sort of first step to sort of improving our industry, I think it's a good move. The only thing that I think we all need to be cognizant of is some of the reforms are sizable, and this is going to take a number of years before we all start to see the benefits of those reforms in our particular sort of areas of the industry. So that's just something to be mindful about, albeit it's a step in the right direction.
So, I know we're almost at time, and so and there was a question around AI and ML, which we sort of covered, but we can maybe cover that afterwards. But I mean, where do you just to close, where do you sort of see us going in the next sort of like 5 years or so? I mean, maybe Chanuka, do you want to start? I mean, sort of given where we've come, we've talked a lot about where we've come, where we might be going.
Yeah.
What's your prediction?
I mean, I don't have a magic ball, and I think 5 years is actually too long for me to predict. Honestly, I don't know if I can predict 2 years
3
from
months.
now. But I think what we're going through is a cautious phase right now. We've just come off the back of the cost of living crisis. I think people are still recovering from that, but what we're seeing is consumer sentiment is still strong. We're not seeing a weakening economy, so we're quite confident in our position at the moment. We don't expect a downturn essentially at this point in time. People seem to be just chugging along. Whether I think there'll be more affordability, there'll be more money in the economy, that's a different question. But I think the economy will stay stable for at least a bit longer from my perspective.
Yeah. And then what's your outlook?
I think there's going to be a lot more emphasis on financial education, credit information, in terms of consumer-facing information. But I think, at least in the short to mid-term, that will result in a further striated population. That not just the haves and haves not, but the knows and knows not.
Interesting, George.
Similar views. You talk about the distribution of kind of consumers' affordability as an example. That feels like it's becoming more M-shaped in the sense that kind of middle population that felt a degree of affluence is shrinking, and it's going two ways, and that leaves some challenges for lenders. So think about the mortgage market. The vast majority of consumers haven't really gone through their rate fix shock yet. There's still a large proportion to come. The knock-on implications into the consumer credit market, into the unsecured markets, really severe. So I think that it's going to be a challenging set of circumstances for consumers to continue to adapt to. And I think the bit that worries me more than anything else is that lenders continue to serve the market appropriately, accordingly, and sustainably. And that's the bit that I think is going to be really tough for us all.
Yeah. And last, Neil, what's your kind of view on the outlook?
I'm really positive. I think the UK credit industry, more often than not, does a really good job, across all the different areas that we operate within. The biggest thing for me is I'm seeing real intent across the board from all of the different, from the sort of regulatory through to the supply side, through to the lender and creditor side of it, to address some of the inequalities that we have observed over the last few years. There is a genuine intent from this, this group, this industry, to do something about that, and that will, ultimately be positive for everybody, not least the consumer.
Okay, well, fantastic. Well, thank you to everyone on the panel. Eleanor, George, Neil, and Chanuka. Really appreciate the insights. Really interesting to sort of, you can see how things are starting to change, and like some of the ideas around like how we got to think about how we need to change as well. So I think it's fascinating. So thank you very much. I'm going to hand back to Colin.
Thank you, Chris. Great. Thank you very much, panel. Really good. Really interesting discussion there. Had a couple of questions come in. Like Chris mentioned, we'll cover them off. Some of them we didn't quite cover, but that's fine. We'll cover them off in our review. But I'd like to just round up by saying a big thank you to our session sponsor, LexisNexis Risk Solutions, for sponsoring this session. And obviously, thank you to Chanuka, George, Eleanor, and Neil for their insight, and of course, Chris for chairing the session. For those of you going to join us on the next one, that starts at 10:45, so in about 15 minutes' time. We'll be talking about open banking and the future of lending on that one. But for now, I'd like to say a big thank you to everybody who's tuned in as well. And I'll hopefully see you at a future event. Thanks, everybody. Cheers. Goodbye.